type places. And then you'll see other things like ADRs, which is market that is powering it. So what would be interesting, what we think is interesting, which also drives our product development is firstly the A-share market. So these are what we call markets that are difficult to access directly. So the A-share market is, best indicated by the FTSE A50 index, which SGX has listed for many years. So that market gives you access to the Chinese market, onshore market. And then what's more interesting in recent times is what we call New China. So these are the shares that are listed outside of China, but have seen lots of growth potential. And these include what we call the BAT stocks, that's Baidu, Alibaba, and Tencent. So these are the three stocks that are most well known. So the index that tracks these types of technology companies is best represented by the MSCI China Free Index, which we have also listed. So you have a combination of what we call old economy China in the A50 index, which the main of the big part of the component stocks are the financial types. For example, Ping An Investment, the insurance companies, the banks. So what we call the old economy type stocks, and then you have the new economy type stocks, which are all the technology companies, the new economy type companies. So these two are all listed on SGX. And in 2017, the A50 index grew about 30%, but the MSCI China Free Index grew 52%. So that's kind of an indication of the kind of trajectory that the two types of stocks are growing at. Of course, you could look at arbitrage type opportunities between the old and the new. So those are some of the ideas that the investment bankers and stock outlook pundits have been looking at. Now, turning to India. So India is the other big economy, and that's been enshrined in the Nifty 50 index futures, which we have listed for more than 10 years now. That grew 29% in 2017. So that's also another interesting market to look at. So, that is, so the easiest way to access these, what I call difficult to access type economies, because there are always restrictions for foreigners. And of course, there's that currency risk, is to trade them on SGX, where, it's in US dollar, and it is, you have free access to trade them, and at a very good leverage access, meaning that you don't actually have to pay the entire notional, you pay what's called margin, which usually is between 5 to 10% of the actual notional. So that's something to look at. And of course, the other product that's very interesting is options, right? Options on the Nifty Index futures, which is a very exciting product because options allows you to gain access to the upside while limiting the downside. So that's an interesting one to look at. Thanks.
Great. Thank you very much, Lily, for showing us why China and India should be in everyone's minds when they're looking at their international investment portfolio. Before we continue, just a quick reminder to our audience that, please, we'd like to know what questions are important to you, but please use Slido to present your questions, and then the questions with the top votes, we will present it to our panelists at the end of the discussion. So, just a quick follow-up, Lily. So you've presented to us why we should be interested in China and India. You've also spoken about the advantages of using leverage in there. Could you perhaps just quickly touch upon, maybe some of us might have concerns about, when we're experienced in using equities and funds in terms of getting exposure to India and China, but we might not be as familiar in using futures as a primary investment product. Perhaps you can touch a little bit upon some of the risk management that we can do to mitigate some of these concerns.
So a futures product is a standardized derivative product. So it has an underlying which is locked in to the actual assets. So it is what we call a paper product. You might have heard that term, paper product. So it is cash settled in most instances. There are physical delivered products such as the rubber futures that we have, but that would mean that you would need to make and take delivery on the last trading day. So a futures contract basically tracks the movement of the underlying asset and converges, meaning that it will trade with a future element, right? Meaning that when somebody trades, for example, if you want to trade the A50, okay, it trades at a certain level now, and then the futures contract will trade at a level that is usually higher, that has a forecast on what the market thinks it will be when it expires. So everyone is trading up and down, thinking how that index will show up at the end of the month. So that's how futures works. And every day, you would think that, is that a very risky thing? The way that the exchanges manage that is by doing a mark to market every day, meaning that their position is always marked to where the market is for that day. And you actually have a P&L, a profit and loss element to your account whenever a price goes up or down. So then that's where Phillip Futures will help you to sort of manage that sort of cash flow. And that is in addition to the margin that's payable on a per lot. So that will create your margin account. So that's how the cash flow will look like. So I think there will be more technical workshops that Phillip Securities will provide to let you see exactly how that is going to affect your cash flow. So it's important to understand that mechanism before you enter into the market.
Thank you very much, Lily, for pointing out the advantages of using futures in addition to funds, ETFs, and equities in your investment portfolio. Next, I'd like to invite our panelists from Malaysia to perhaps provide a little bit more of a perspective. I mean, we've heard from the larger regions such as China and India on why it's a great investment there, but China is committed to growing the whole region. In fact, during the last conference, they committed to importing over $2 trillion from neighboring countries in terms of imports. So this has a tangential effect to countries such as Malaysia as well. So the question to our panelists from Malaysia is, how should investors and traders view a market such as Malaysia as part of a larger ASEAN or One Belt, One Road portfolio?
Right. So we have heard about China, we have heard about India, and I'm trying to fit Malaysia into this team, right? But as an investor, if you like China, you like India, then definitely you like the emerging market space, right? And definitely Malaysia fits well in the emerging market space, right? And again, this for the whole benefit of the audience here from diverse backgrounds, some fund managers, retailers, individuals, right? So as an investor, when you look into investing into an emerging market, let's say Malaysia, for instance, right, or any emerging market, what's the first thing that you will come into your head? You will look into whether there's any crisis in that country, there's any turmoil and such, and Malaysia has none of those, right? It's stable, right? And of course, the next thing you look into the government policies, and you look into the fundamentals of the economy, right? So in Malaysia, we have very strong fundamentals. We have a GDP growth of about 5%. Our ringgit last year has performed quite well, right? We went to 450 and now it's below 4. That's about 10% growth, one of the best in Southeast Asia, right? And the third question is for foreigners who wants to invest in Malaysia or any emerging countries per se, one of the very important things that they will ask is that how's the FX policy? Is it easy to get in and actually to get out, right? And in Malaysia itself is easy, right? As such, you can see evidence from there are about 25% foreign participation in our equities market, right? There's equivalently about 25 to 30% participation in our bond market, which is very healthy. right? And the important part about the FX component is that when foreigners come in with their dollars or any currency into the ringgit base, because our assets are ringgit based, and whether they're able to hedge that portion of their return. Because you may choose an asset class to invest in, equities or bonds or commodities per se, but your returns could actually be wiped off by the FX swing, right? But in Malaysia, you can actually effectively hedge your FX underlying quite straightforward. If you have underlying, you have equities, you have bond, you can actually do a forward contract on that, right? And there's no issue in that. So because of this flexibility of this FX regime, and also in terms of good fundamentals in Malaysia, investors can actually look at Malaysia and position themselves if they want to be a part of a growing emerging country, and in terms of stability of government and such, and also the potential to grow further. Yeah, thank you.
Thank you very much, Kenneth. I think Malaysia is a great opportunity as well. Just because it's a smaller region doesn't mean it does not get the benefits of the wider theme in Asia, under the theme of growth in Asia that many of you have said is important to you. I'd like to look into the Middle East as a potential investment opportunity. As we know, the Middle East is a vital trading area. Oil prices recently, as you all know, have been on the upswing. My question to our panelists from Dubai is, how should investors balance, on the one hand, some of the geopolitical risks and uncertainty that we hear about in the news, but on the other, the recovery in commodities such as oil, as well as some of the structural reforms that have been successfully going on in the region, such as in Saudi Arabia?
Thanks. I think this is a very good question. I think you've been in India, you should know about the region, but I think it's good to share some of the insights in the Middle East. I think 2 years ago when the oil price came down, there were a lot of pressure in the Middle East. There were a lot of structural reforms done by different governments, not only Saudi, but in UAE, Qatar, Bahrain, reforming, consolidating the government-linked companies, looking at different various opportunity to capitalize, reissuing contracts to their suppliers on the oil and gas side. I think this is a very good opportunity for trading the oil or energy market, because some of the reality check has been done in the Middle East, the check and balance. They realize also that they are not the most important anymore in terms of the oil price, the OPEC influence. They also know that there are other regions that provide alternative energies. So they are beefing up in terms of what next for them. Some of the things that they did is they invest heavily on the downstream industry, where the petrochemical industry will be booming. Look at the price of the polypropylene that in the region. I think PTT is also affected or benefiting from the increase in the petrochemical price. Yeah. On DGCX side, we are also well prepared in terms of the growth on the energy sector. We introduced the energy spread end of last year so that investors can really look into hedging or participating into a 12 months to 18 months oil price movement, looking at the price differential between now and then. So yes, we are preparing the growth with the Middle East, not only on the oil price, but also into diversifying sectors. You know, some of the things that we spoke, especially I'm from Asia, I spoke to the participants that, hey, why do you want to set up something in the Middle East? What are the benefits? Is it because of the feedstock? Is it because of the transportation costs, lower transportation costs, let's say in Jebel Ali in UAE? These are some of the key considerations for participants to put investments into Middle East. Thanks.
Great. Thank you very much, Mr. Min Cheng Chiu. I think now Dubai is a great opportunity for that. And also later we'll touch upon some of the other geopolitical factors that affect investment in this area. But real quickly, I just want to quickly take a segue to look into our audience questions, because we want to make sure that this event is right for you as well. So in your polls, you've mentioned that the growth in Asia and alternative investments such as Bitcoin is important, and we will spend some time with that. But I just want to quickly address some of the top questions here. So the first question is, Crash, what should we do to prepare to exploit this incoming crisis? Do we have a volunteer from the panel to address this question? Perhaps this, maybe if we rephrase this a little bit more and say that, okay, what are some of the factors which investors should be careful or worry about? Not necessarily saying that predicting that it's going to crash. Does our panelists from the CME want to perhaps provide some of the views?
It might be useful when looking at this question to review the most recent past as a working example. The great financial crisis of 2007, 2008 was probably the greatest negative economic and financial event in 2 generations, and it was precipitated in a climate of unregulated and irresponsible financial speculation. And as a result of those disastrous effects, and admittedly most of it from North America, the global nations, G20 nations, have put their heads together and said, something has to be done about this. And there's been reforms in the OTC space that have resulted in greater transparency, deleveraging of the global banking structure, as well as regulations moving products more to a futures model in terms of post-trade risk management things. These are things that are common to all of us and all of our exchanges. They're matters of business management that we've used for generations to manage and mitigate risk. That's our business. We don't create risk, we provide products and systems to manage existing risk. And this wasn't wasted on global regulators, this last event. And the transition since then has been the movement, either through regulation or by choice, to move to exchange-listed and cleared products because they offer transparency and equal access, the marking to market to real price structures instead of make-believe, and then also the imposition of collateral to support open positions. This has done marvelously great strides to take systemic risk that used to exist in our marketplace and manage to reduce it tremendously. So looking forward at what might be a potentially next economic crisis, I would at least like to say that I think even from a global risk management structure, our systems are much better positioned today to be able to deal with financial risks, especially as they relate to financial products. And that is a direct result of the industry that's represented by this panel here.
Thank you very much, Mr. David Gibbs. I hope that answered some of your question there. The next question then, maybe since this is important in terms of what everyone is looking at, I'd just like to maybe continue with you, Mr. Gibbs, with your permission, since, as we all know, CME has launched a Bitcoin product. So maybe if you could just, maybe just taking a step back from this question a little bit, and first perhaps talk a little bit about why should investors who are looking at cryptocurrencies consider to invest in this? Mr. Gibbs?
Well, that is probably the top of mind of 90% of this audience, and it's not restricted to this room. Bitcoin has grabbed the world's imagination. Cryptocurrencies, regardless of their name, are top of mind and top of every media, broadcasting, print, and otherwise around the world all the time these days. I think when it comes to Bitcoin, and other cryptocurrencies, we need to take an arm's length view of this and let's see how it develops. What I would say is that the technology that's behind cryptocurrencies, the idea of the blockchain technology on financial records, financial settling, that is something that is going to be with us forever now. And the changes that will occur as a result of the development of that technology are very real, and they will transcend the futures industry in terms of their impact. In terms of the Bitcoin futures themselves, we're going to have a whole session on that later this afternoon. But just quickly, our contract is designed around, like any other of our index products, around an index, so that its price is influenced by many inputs rather than just one single price point. And like any other cleared futures product, it is mark to market, settled twice a day on our mark to market twice a day on our Globex system, and losers pay winners every day. There is no loss carry forward like any other cleared product, and the open positions are margined, and in this case, margins based on the volatility of the product. So it is a heavily margined futures product and will be, because it represents the volatility of the underlying. Why would an individual or any other investor choose to look at the futures product? Primarily for that reason. The pricing is transparent. It's available 23 hours a day. It is marked to a real, discernible, transparent price, the Bitcoin reference rate or the BRR reference rate. And open positions are secured by collateral posted with a clearinghouse that does not make a market, but manages the risk of the post-trade transit. So like any other futures product, any other cleared product, the advantages are the same as any other. Our responsibility is to not to promote the trade, but to manage the risk.
Thank you very much, David. Just to follow up on that, as we all know, the price of Bitcoin has been going up and down. It's been really volatile. Could you perhaps provide a little bit more details, and perhaps, if are the futures products only for someone who has a bullish view of Bitcoins, or can someone who thinks that, the price of Bitcoin perhaps is going to go down, how can they participate in this product as well?
Well, it's a futures product. It's a futures contract. It's just as easily to sell short as it is to go long. That's one of the advantages of our industry. You don't have to, first of all, you can't borrow Bitcoin to sell it short, the physical. You can't short the physical. The only way to short this underlying product is through the listed futures product. So that is a very clear, distinct, and differentiating advantage to the listed futures product. If you're long Bitcoin and you're looking to either lock in your profit or reduce your risk exposure, this is the only avenue that I'm aware of that you can use to offset that price depreciation. I don't think it's not more complicated than that. It's a futures product. Its price behavior will reflect the inputs in our contract based on the index value, and the losers will pay the winners twice a day on a mark-to-market basis. So in terms of encouraging people to trade it, that's beyond my purview. Our concern is strictly dealing with the risk management function.
Great. Thank you very much, David. So to recap, for suitable investors, Bitcoin futures is an avenue where if you have a view that it might go down, this is an avenue where you can express it. Great. So on the same topic of cryptocurrencies, perhaps let's get a different point of view from perhaps our representative from Korea. Recently, Korea has been in the news with Bitcoin because prior to this, correct me if I'm wrong, but Korea has been one of the most active cash Bitcoin markets until the government kind of put some controls on it. As a result, I think about 100 billion in market cap of Bitcoins worldwide has gone down since then. So perhaps, Mr. Lee, you could provide a unique perspective on what you feel is the role of exchanges in terms of regulating and provide cryptocurrencies, maybe not just Bitcoins, but just to touch on the audience questions, potentially other cryptocurrencies such as Ripple and Ethereum as well. Mr. Lee?
Yes, I prefer to say cryptocurrency instead of a Bitcoin because there's so many kind of cryptocurrencies going on, and I believe that 90% of cryptocurrency will extinct soon. And let's say this is a really interesting product, and as an exchange, this is a business opportunity for us. We study all the cases and studying the possibility of being listed, like CME did. And also we're studying the possibility of using cryptocurrency as settlement payment method. However, our government doesn't consider Bitcoin or cryptocurrency as a financial product. And the attention is paid to excessive concentration on what you call too much speculative fund in unregulated market. They feel this is the real problem. And that's why under the related Korean law, we are not allowed to list the non-financial product. And we have to go with our government together. So from now on, at this moment, we just study internally as an exchange. But I'm sure the time will come up soon. But we know the all possibility behind cryptocurrency. Mr. David is talking, there's blockchain technology, or cryptocurrency can play as a role as the currency. We have to see that. So we need some time as a Korean. Okay.
Great. Thank you very much, Mr. Lee, for providing another perspective on how exchanges should view cryptocurrencies as an alternative investments. Now, before we continue, I would just like to take this opportunity to invite our audience once again to participate in our next poll. So we've heard your feedback in terms of what are the areas that's most important to you, and we hope we've provided the answers. But in addition, we'd also like to know, now that we've heard about some of the opportunities in global offshore futures investments, perhaps you have some questions or concerns, and let us know what are some of your biggest concerns on trading global futures. Great. The new innovative products such as cryptocurrencies, Bitcoins, but the reality is that it's still a very small but growing part of the market. A more established part of the market is commodities. Commodities futures in particular is something that is not foreign to a lot of our Thai audience. I'd like to take this opportunity to pose a question to a representative from the Tocom Tokyo market on the most popular futures product in Thailand, which is the Tocom rubber contract. Mr. Seki, what do you think are the different factors which investors should consider in the coming year when trading rubber?
Okay, that's a question. Okay, I'd like to present my view on the rubber product. We are, frankly speaking, we are right now, the rubber price is suffering tight range price movement right now. Trading volume is going down. And when we look back maybe 1 year ago, there was a rapid price hike, especially around time of January and February, price reaching 360 yen per kilo in our market. So that was a very rapid move. But after that, price went dramatically down. Thank you. Sorry. And so when we compare with the other asset like equity going up, crude oil going up, gold prices going up, but unfortunately rubber is not the case. It stays at the low level. At the beginning of the year, people focused on Chinese economic indicators.